I'm Victor Cantore. I'm the president and CEO of Amex Exploration. Amex Exploration has a high grade, and now I can actually say it's a highly profitable project in the Abitibi in the province of Quebec.
Good to have you here, sir. Welcome to London.
Thanks for having me.
It's the end of the week. It's been a long week. I guess it's super busy next door. Lots of meetings for you guys. Have you enjoyed it? Got anything from it?
Oh, I love it. Lots of people, lots of traffic.
Yeah.
I have our mining engineer here. I have our geologist here. So it's great. We're having a lot of good meetings.
Well, you put the PEA out. That seems to have had a good reception, but it hasn't fixed the reaction from the resource which you put out. So maybe for people new to this, maybe looking at your chart, going, what's happened here? Explain the kind of the linear activity there, and let's get into the economics. I think that's the exciting bit.
Sure. So we put out our resource. I think the resource wasn't understood well. There's always that famous number of 1 gram per ton. You need 5 million. You need at least 5 million ounces. But when it's a high grade deposit, you don't need. And I'll say something very simple. Like if you have a ton of rock and there's 1 gram of gold, and we're going to assume that they're all the same conditions. And then you have another one where you have the same ton of rock, but there's 10 grams of gold, right? It's pretty simple, like which one is going to be much more profitable. And the fact that we put out 1,639,000 ounces, yes, it's a lot smaller than maybe what people were expecting, but conceptually you could build a mine. It could build a mine, and that's why we put out the PA on it.
Right. Okay. It'd be kind of useful if you guys let us put up those things at the same time, because I think the economics, and I guess you need the resource to inform the economics, et cetera. But for the market and for most of us retail, we look at conversations around, we need 5 million ounce project. That's the only way that's going to be attractive to potential buyers, and it's the only way it's going to be economic. So your PEA tells us what?
So the PA tells you that you can build a standalone project with a low capex. The capex, you're looking around $230 million. So what we would be doing there is emptying out the four pits right away.
Yeah.
Set it aside, get ready as we're doing construction. So we put that in the capex. So the sale of the gold of those four pits ends up taking down the cost of your capex. So from 291, we end up going down to $230 million.
Right. But give me some of the numbers there, because you say high grade, people may not have heard your story before. So remind us of the grades, the returns, and any other numbers you think pertinent.
Sure, absolutely. So when I'm talking about high grade, the high grade zone, both with measured, indicated, and inferred. You're looking at pretty close to 11 and a half grams per ton, pretty close to 12%. In the measured, you're looking at 15.94 grams per ton. What's really nice about the deposit, when you look at the high grade zone, it dips down to something like 89 degrees. So like they say, that's a mining engineer's dream, because you can put a ramp there. It just sinks right beside it. You're not chasing. You're not chasing gold here and there, and eventually you could just drift over. You have the Denise zone and the team zone that are close by to the high grade zone, so you can drift over and go get the balance of it. So, and if I go property wide, where you're taking the lower grade ounces from the open pits, you're looking at 4 grams per ton property wide, and look, that whole thing about location. So you're just next to the town. Like if somebody would want to tell you, where can I build a mine beside this town? That's where you want to build it. It's 5 kilometers by the town. You have an electrical substation 4 kilometers from the where you're going to be needing the electricity. You won't need a workers camp. There's a small population at Normantal, 700-800 residents, but 23 minutes south, you have 11,000 residents, so you can get your whole pool of employees from there.
Okay, so that infrastructure obviously helps keep the capex and the opex down, obviously. But again, I think the core thing here is, what does the PEA tell us in terms of IRRs? What does it tell us in terms of revenue? Those are the things I think get the juices flowing.
Absolutely. So our AISC, you're looking at $807 US,
Below $1,000.
below $1,000.
Wowzers.
And again, the questions come: how do you get that? It's really for what I was saying earlier, because of its location, low cost of electricity in Quebec. IRR is a spectacular. If you're looking at after tax at $2,000 gold, you're looking at 40%. If you're looking after tax at $2,600 gold, you're looking almost at 60%. You're looking at 59.2%. The project actually gets paid back under 2 years.
That's
Actually at 2,600 gold, it's 1.2 years. Well, that's when projects get risky. When you start going 3 years plus.
Yeah.
So here the project gets paid back very fast, and once your infrastructure is all paid,
sunk cost gone.
sunk cost gone.
Yeah, and I think also cost of capital obviously is greatly affected. Like if you're coming asking me for money and you've got a 1.2 year payback, the cost of that capital is going to be a lot less than say if it was like a 3, 4, 5 year payback period. So that's super exciting. But it is just a PEA.
That's correct.
Right. So is there anything that you've done in the PEA that you can take forward? Any learnings that you can take forward into kind of PFS? Because I think in this environment, people think, well, crikey, why wouldn't you want to rush to get into production? But you're gonna, I guess, have to think about that.
Oh, absolutely. So it's in the press release. Our PA, we actually went to get quotes for all the expensive equipment, all the large equipment. So we wanted to make this as real as possible. When it comes down to the where do you go forward, I actually want to increase our resource.
Yeah.
And so we presently have 2 drills turning. We're going to make a decision sometime in January or February whether we're going to increase the amount of drills. So what I would like to do, which again it's with all the waivers it's speculative, I would love to put out a new PA and a new resource so sometime late in 2025.
PEA.
Absolutely. You got to attach economics. I'm a big believer.
Okay.
You have to attach economics to any resource.
But I'm thinking of the things, all the options on the table for you. It could be a case. Well, let's rush into PFS and feasibility study and get going, get some revenue flowing. And with these margins, why wouldn't you? But you're indicating maybe we can add some more ounces.
Absolutely. So we can try to add more ounces. So what takes long is always permitting, slash environmental.
Right.
We are doing we've done some baseline work. We're going to continue doing the baseline work for two reasons. One, you keep checking the boxes as you're moving, you're de-risking, checking the boxes on de-risking the project, and you're advancing on the baseline work. So for that, you look out for press releases on that. We are going to be announcing it anytime that we do something that advances it on the permitting and environmental side.
Right. And because of that, you think the best use of your capital is, okay, 2 drills, maybe it's more drills. What's that going to do for us? Is that going to give people more confidence about the size, potential, and scale of this thing? Is that the goal?
Absolutely. The deposit is open in all directions.
Okay.
In all the zones, it's still open in all directions. So it comes down to where is the money better spent to enhance shareholder value. For me, at this point, it's better spent increasing the resource than versus. So let's say you needed 30,000 meters to take all the inferred from the high grade zone in order to bring it to the indicated level. That'd be $6-7 million. Now, I would say I'd rather spend $6-7 million finding new zones, finding another high grade zone.
Right.
I think I think you enhance the value you're enhancing the value for the shareholders by increasing, finding economic ounces. And now that you actually have stopes and block models, you're in the existing zones, the drilling starts becoming much more targeted because you're going in the areas where there's blanks, and there's blanks in that stope not because of there's no gold, it's just because of lack of drilling in that specific area.
Right.
And we're going to be mentioning that on every press release. When we talk about it, we'll say, well, this went into an empty
It's interesting. Actually, that's an interesting point that you're making there, because you're saying about the drilling and why the allocation of capital to the inferred number, the bigger, broader number of new ounces, as it were. A bit that I'm intrigued by, as I guess someone who's interested in the narrative and the stories being told in the marketplace, is that you've got to tell the story better. Because I think you've had that kind of. Was it a shock when you saw the reaction to the resource? Do you think? Could you have told that story better? Is that why you're saying we need to communicate more clearly going forward?
Yeah, I would have liked to put out the PA along with the resource.
Yeah.
I would have liked to do that. There's ways to report it. We have regulatory rules to follow, and we followed all those rules. So,
But you know what I mean? Like you and I sort of, there was a phase where I was saying, "Oh my goodness, not more drilling! You keep finding this high grade gold. How awful!"
Yeah.
Joke. And do you feel under pressure to put out a resource? And if you did, was it reluctance on your part, or do you feel the time was right?
no, I think the time is right, because right now when we're going to conferences and talking to investors and potential buyers, it's now I actually have a resource that you can see it's a standalone.
Yeah.
It's a standalone mine. It's not a resource that's orphaned. That my best scenario would be only to toll mill. We've shown that with the capex. So now it's just a question of so now I know I have a mine. Now it's a question of growing the mine. How much bigger?
You have an economic mine.
Yeah, I have a very economic mine.
Right. So if you did nothing else, that's fine. Stands down. It's all good. You think now's the time to say, look, we can make this resource bigger. You're going to need to signal to the market, the scale that you're looking for, in case they expect you to come back with 5 million ounces.
Yeah.
Because that's may or may not be what you do. So
It's not. I know ounces. It's like I think the market gets too fixated on the ounces. It's really the profitability of the project. When you look at our economic study, making money is yeah. When you look at this economic study using $2,000 gold, you're looking at the free cash flow of $133 million.
Oh wow, that's a number we should have talked about earlier.
Per year.
133 million per year free cash flow. That's not revenue, guys. That's free cash flow
at $2,000 gold.
Okay, we should have started with that.
Yeah.
So this is a big profitable mine already. Why wouldn't you get going with this now? That's the cry. Is it because you're explorers and that's maybe someone else's opportunity? I mean, why not get going?
Look, if somebody wants to come and buy it, I'm there for whatever is best for shareholders. I'm a shareholder myself, and I've been a shareholder from the day one when I stepped in, and I've bought and paid for every single share that I own. I just want to make this project as big and as profitable as possible. And when we're talking about finding more ounces, I'm talking about finding economic ounces, not just any ounces. And one thing that this Pearl project has delivered is they've delivered high grade economic ounces.
So this could be something quite. So it says if 133 million free cash flow for the first 5 years of a 10-year mine life. That's the 10-year number.
That's the 10-year number. It's 1.3. It's for the 10 years. It's 1.33 billion dollars 10 years.
Yeah.
So we just divided it by 133 million. It'll be more than that. The way we're enhancing the production in the first 5 years.
Yeah.
The first 5 years on a yearly basis, it will be higher than 133.
Okay, so that's very exciting. Because then someone's got decisions to make about what you do with that money.
Well, just think about it. If you're a mining company, you're a big producer and you're looking for other assets. Wouldn't that be something great where you end up buying an asset and then you've got this free cash flow to continue exploration using the profits of that project? Like I think it becomes a very attractive project when with the PA that we've delivered, it becomes very, very attractive.
Okay, lots of upside.
Yes.
And I'll finish off. So 2025, it's going to better communicate. Like I don't think there was anything wrong with it before, but people like to interpret and project, and it was like, but you got to be clearer with people about what you got. But what a cornerstone project to build on. I think it's fantastic.
No, absolutely. Look, we're going to do our best to communicate it as best as possible going forward. I think right now with the PA the way it is, it does show that it's a highly profitable project to move forward. 2025, by the end of 2025, we'll make the decision to go forward with to go forward with putting this thing into production as fast as possible.
Okay.
I mean the rest of it I can't speculate on it, but a lot can happen between here and
of course, a lot of things need to go right and in the right order. So back to the kind of permitting licensing side of things. So typically in the province, how long do those things take?
it'll take a minimum of 2 years. All projects now, I got to look exactly how it is. Most of the projects you got to go through what they call a BAP. It's a BAPE. It's an acronym.
Yeah.
2 to 3 years. If everything's aligned, you should be permitted. And I speak that's probably the lower. That's probably for Quebec. That's probably the lower end of it. The reason I say it's that we could probably get it done in that period. Again, I'm speculating, but we don't have any lakes or rivers to deal with. So I mean that usually takes up a lot of time.
Yeah.
And the other it's in the PA. The other factor is that the tailings management facility, that's usually where you get your cost overruns and you get your delays. So what the government wants you to do right now is if you have a pit, they want you to take your waste rock and put it back. It's like you're taking your country rock and putting it back into the pit, so you don't have a tailings management facility to deal with. And right now it fits like a glove. You empty out those pits, and all the waste rock goes back, including all the waste rock from the high grade zone. All goes back into the pits. That's why we would do the pre-production, where we empty out the pits immediately.
Okay. Well, I'm looking forward to seeing how this rolls out next year. And more drilling, I'm kind of for that, and getting after those ounces, but also moving the economic understanding forward as well, because I think it's a great time to be a gold producer.
Oh, I think so, and we'll communicate it. We'll show our numbers. I think we'll try to communicate it in a better way.
Good man. Good to see you.
Thank you.
Cheers.
Thank you. Cheers.